There was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today.
Jay Powell there speaking after the Fed held rates steady and signalled a cautious outlook. You're watching the China Show this morning. I'm Annabelle Droulers with David Ingles.
Good morning. We are counting down to the open of markets in Greater China. Let's get to your top stories today. A massive, massive day for tech earnings. You have Samsung and SK Hynix each reporting record results as this AI wave shows no signs of breaking.
Yeah, that's the Korea story, but you've got the US as well. Tesla, Meta, IBM gaining on strong numbers, AI plans, but investors fearing, you can see there, Microsoft's AI investments might be slow to pay off.
Now, commodities are surging with gold extending this record run. Brent crude also rising to 6-month highs. The dollar rebounding as the U.S. Treasury Secretary backing a strong currency.
And the UK Prime Minister Keir Starmer arrives in Beijing, pledging to seek a more mature relationship ahead of today's meeting with President Xi Jinping.
Good Thursday morning. Welcome to the program. As is customary, we need to talk about the Fed. It's, of course, a couple of hours post this largely non-event. You had two dissenters, of course, who voted in favor of a rate cut. And it doesn't seem, based on the guidance bell coming out of the Fed, that there will be room to cut interest rates before Jay Powell's term ends. But I guess that is largely expected right now.
For me, I think the dissenters are the most interesting part. And, OK, Stephen Myron, maybe you could have expected, but Governor Chris Waller, I think, is an interesting move because it's sort of like, is he auditioning for the Fed chair? Is that what kind of keeps him in the race? Or is he really just reflecting concerns around the overall health of the labour market? We don't know that, of course.
Yeah, well, we need to get into his head as far as that is concerned. But I think when you look at the data, it's certainly proved a little bit more resilient of late compared to the last couple of meetings. So you could make a stronger case right now for a hold, not just today, right, but moving forward. And then I guess we can set that aside because certainly when you look at the price moves in the markets overnight, the context was this time yesterday we were dealing with an absolute collapse in the U.S. dollar, and complete opposite right now, coming through out of comments out of the Treasury Secretary talking about how it is a strong dollar policy. There are no way intervening in the Japanese yen, which is, I think, the other big story we're tracking today, apart from tech, which obviously is, we have to talk about that too.
I mean, tech is very much front and center, really. These are big earnings. We've just kicked off the earnings season again, and you came into the session today, so you had Tesla, Meta, Microsoft, IBM. They were the big numbers in the US. You already had SK Hynix yesterday afternoon, but you had Samsung as well this morning, and it's that bigger story around, yes, you're seeing the memory chip crunch that's certainly starting to have an effect, but also different views on CapEx spend, essentially, because both Meta and Microsoft are scaling up their spending plans for this year, but only one of those is being punished for it. Yeah,
and we'll see what that perhaps portends, because you have Alphabet coming through next week as well, and Amazon, of course. And I think you put the CapEx together, I think it's $500 billion between the biggest spenders, right, as far as CapEx is concerned, as far as the estimates go. Right, so we're going to get into all of that right now as we look at markets, and I think to the point Bell was just making there on Samsung and SK Hynix, perhaps prices are folding despite the fivefold increase, at least as far as Samsung is concerned, as far as the chip business goes. More on that in a moment. We also did get, by the way, a rate decision coming through, monetary policy decision, to be more specific, out of Singapore. Speaking of Southeast Asia, flip the page, please look at tech. While we flip the page, the Indonesian story is one we'll get into really as well, following just one of the worst days for that market. On record, really, as far as many superlatives are concerned, around concerns about investability. Here's the tech player as far as the Samsung story is concerned. Nasdaq futures are flat. Big bounce in the dollar, big dip, as you can see, big dip into yesterday on dollar yen. That's reversed somewhat as we speak here. Starmer, of course, has a full day ahead in mainland China. And, of course, we're looking at commodity prices where arguably, this is still really the story to track. I think people are sleeping on this recent peak up in oil prices, right? So 17%, I believe, from the bottom on Brent, 13% year to date, highest since late July. Iran's featuring into the conversations today. Gold spot 5,500, silver's 120. Let's call it even there. A50 futures, MSCI China, big pop yesterday. We'll see what happens today. And of course, dollar China. And there we go. Yeah, on the two rates and the difference between the two. We're largely looking at declines given, of course, perhaps the bounce yesterday.
Yeah, but let's get back to that tech story because it is really front and center for us. As we said, we had Samsung, SK Hynix here in Asia. There's Meta, Microsoft among the headliners from the US. But our team is here to walk us through the results this morning. We've got our Asia equities reporter, Sang-Mi Cha, with us in Hong Kong. And also from San Francisco is our tech reporter, Riley Griffin. But Sang-Mi, I think we can start with you. So yeah, it's pretty unusual to see SK Hynix and Samsung reporting, at the same time, their earnings call within an hour of each other this morning. But what have we learned so far and what are really the highlights for you?
Yeah, that's right. It really looks somewhat of a face-off rather than a coincidence. It really goes way back to when this really happened in the past. But again, the whole focus is that, they've both reported amazing earnings, and SK Hynix, just like you said, had the best quarterly results, and Samsung's chip business is roaring back. But again, today we're seeing the share moves actually falling, and that's, actually quite usual for the Korean market. Investors are taking profit. But again, traders are saying this is the best opportunity to buy the dip again because all eyes are on these memory chip prices, which Citigroup estimates about 120% increase for DRAM and 90% for NAND this year. So all of this record shortfall in these conventional memories is really resulting in some of these upsides for Samsung and SK Hynix. And it's really interesting that this customer base for these memory chips have entirely shifted. In the past it was the PCs or the smartphone makers who would actually delay the buys if the prices were too expensive. But now it's the hyperscalers that you just talked about who have lots of cash and they're just, putting down the cash so that they can get some of those capacity for these memory chips. And all of this actually comes down to the high bandwidth memory, the HBM, in which SK Hynix is the leader and, of course, the very strategic partner to NVIDIA, but also local media saying that it will be the exclusive supplier to Microsoft's Maya chip. So all of this is boosting the share prices.
Do we know anything more about the guidance on pricing and supply of HBM?
So that we will be hearing more on from the conference call, which we'll hear more about. Yeah. But of course, again, the HBM is a space that is taking up so much of these manufacturing capacity from these two companies. And what's interesting is normally these conventional memories, they were booked quarter-based. So, you book this quarter, and then if you fall short, then you're not going to sign. But now they're moving towards like 1 year basis. This is what the investors are betting on. And they're saying that this is no longer a cyclical kind of business, but it's an entire structural change that we're seeing here in the space. And also because of these HBMs that require so much of the wafers, the silicon wafers are finite, and because of that, and they require, I think it was about 3 times the silicon wafers that is required for this conventional memory. So now the DRAM and the NAND prices also are soaring because of that.
Yeah, it's sort of that pivot toward HBM that's cannibalizing the production of conventional memory that's taking a lot of supply out of the market and hurting a lot of those PC and smartphone makers. But Riley, let's bring you in now because we were talking about CapEx plans and CapEx plans being so significant across the tech space generally for this coming year. Meta is being rewarded for it. Microsoft, of course, going in the other direction. But why is that?
Yeah, that is based on the strength of Meta's earnings today, both in the numbers that they reported for the fourth quarter and the projections for the first quarter, which beat analyst expectations easily. As for deploying cash, Meta estimated that full-year capital expenditures will be between 115 and 135 billion, easily beating the 110 average analyst estimate. I want to put that in perspective for you, though, because if Meta hits the top end of that range, it will mean a jump of roughly 87% from 2025, which was already a record year in which CapEx topped 72 billion.
Okay, wow. So that's quite a jump. Riley, where does that money go? What's going to be funded here?
Yeah, yet another year we're going to see cash deployed to data centers and the infrastructure that is bolstering this AI race. That means chips, that means talent. this is a year where we're going to see Meta continue to double down on what Mark Zuckerberg, the CEO, is calling an effort to front load capacity. He's hoping to gobble up that capacity right now in an effort to reach that goal of super intelligence, which is a theoretical milestone in which Meta will see AI exceed human capabilities.
Riley, thank you so much. Riley Griffin there and Sang-Hui Cha on the latest tech earnings. In fact, to stay on that theme here, lots more, of course, have been reported. So we talked about Microsoft, more details on this. So slipping in late trade, as we just showed you earlier on. The company, well, spending took a hit, spending hit a record rather, and cloud growth slowing, fueling concerns over the payoff from its AI investments. And the capex in the second quarter hitting almost $38 billion here. That's up 66% from a year back. Now, cloud revenue rose 38%, just in line with expectations. Now, Microsoft expects similar Azure growth in the current quarter. Tesla's another interesting one, streamlining its vehicle portfolio while mapping out $20 billion of investment this year as the company pivots to robotics and autonomous driving. It also plans to invest about $2 billion in Elon Musk's xAI. In its EV business, Tesla says it's discontinuing its Model S and X programs. Fourth quarter sales fell 16% from a year back, but earnings per share of 50 cents coming in higher than expectations. We will have more on the outlook for Tesla later on in the show.
Also counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. You're watching the China show. Futures looking to some slight losses at the open. More ahead.
The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. There was broad support on the committee for holding today. Broad. We will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases.
I'm wondering what advice you have for whoever your successor might be.
Stay out of elected politics.
Okay, that was the Fed Chair, Jay Powell, speaking after the FOMC keeping interest rates on hold and offering some advice, of course, for his successor. His term ends in June. You look at pricing between now and then, there doesn't seem to be a window at which he'll be helming, of course, the Fed. They will deliver. Things could change, of course, but expectations are no move from the Fed based on market pricing all the way through to the end of Jay Powell's term. Joining us here on set to talk us through implications on treasuries, rate cuts, anymore, the dollar, and all things fixed income. Joining us here on set, Masahiko Liu, Senior Fixed Income Strategist at State Street Investment Management. Good morning. Nice to see you.
Good morning, David.
Market sees maybe 2 cuts this year?
Yeah.
How many do you guys see?
We see around 2 to 3 cuts.
Okay.
Right? Pretty much the same, and maybe later half of the year.
Okay.
Right? First half of the year is going to be a pretty good year in the U.S. just with all the fiscal spending coming out.
Right.
Right. Later half, you see a bit of this the midterm election coming up, and then into next year, if Republican loses the midterm election, that might have some implication on the fiscal spending restraint on U.S. So we have a bit of inflation blip in the first half, and second half you see that residing. And economy-wise, you see a pretty good year in the first half, 0.5 to 1% of GDP being added from the fiscal spending.
Right.
Second half, you see a bit of unemployment tricking up, and that's when we see, there will be more cuts priced in the market.
Would that be a good representation of the path of the dollar, up slightly and then down into next year? But, we've certainly seen down and then up in the last 48 hours.
We think so, right? The market has priced for 2 cuts, right, of the path of the Federal Reserve. That's why market is pricing in a gradual downturn of the dollar. But what we think is that, that will basically encourage investors to increase their hedge ratio. That is more important, right? That's the flow versus stock effect, right? The flow effect is market pricing whatever near term. Stock effect is when you go into the longer term, midterm fundamentals does work, does matter. And then that's when people start, taking up a bit of their hedge ratio. This is what we've seen lately, right? In Aussie, in Korean won, right? MPS in Korea announced that they will hike their hedge ratio. That helps Korean won in the midterm. And Australia, you have seen the supers coming out. alluding that they will hike their, take up their hedge ratio too, right? So this is what's going to happen in the next, mid to longer term.
What do you think then when you hear the Treasury Secretary, Scott Bessent, touting a strong dollar policy and giving a different rationale for why it actually might go higher from here?
I think, she's basically doing a bit of damage control, right? What we have done regarding last Friday night, especially Friday night for my time, or Friday morning in the U.S., which is like there was a rate check from the New York Federal Reserve, right, on JPY after what MOF have done during my afternoon, right? I think they're trying to control the narrative of market overselling yen too, right? And if yen has excessive of this order sell-off, that will affect JGB. And then if the long-run JGB keeps on selling off, that's not a good news for the U.S. too, right?
Right.
So I guess Japan has basically talked about with Bessent, right? Katayama, which is Minister of Finance, has come to a conclusion agreement that okay, we will try to do something to cool down the market, not let the market, just cool down the speculators, right? The speculative flow, get it away, get it out, and then let fundamentals work itself into late 2026, 2027.
Okay, and do you think the risk of intervention has that disappeared for now? Like, speculative expectations, are they off the table now?
No, it's definitely there. I mean, the line is pretty clear. The line in the sand is 162, right? That was when MOF has intervened for the past couple of years, right?
Right.
So that was 161.9 to be exact. It's 162. Let's put it, rough ballpark. And I think, when yen moved to 159, 160, that's when, MOF came in and did the rate check.
Yep.
And US came in because, MOF basically knew that, if they were to do it by themselves, it's going to be powerless, right? But then when you have US together with you, look what happens to the market, right? Markets are, piling back all this, short position, short covering, right? And that's when you see yen went to 152, but then now it's probably up to 154 now, right? So a bit of, taking breather in the market, and the short covering is probably done for now.
Okay.
What happens though with the election approaching, and do we see any sort of fluctuations, I guess, around that, or any higher level of uncertainty?
Sure, I think the hype overnight is I think the sentiment on the ground in Japan is Takaichi and LDP might actually win single majority by their own party. So I think that will enforce the view that, there's more fiscal spending coming in a responsible way. Of course, right, fiscal discipline is still the key that Takaichi is trying to convey to the market. And that might have a bit of volatility into the February 8 elections in Japan. But the whole point is, right, I think there's a communication gap between Takaichi administration and the market. Look at Scott Bessent, right? He's the best salesperson of U.S. Treasuries, right? And when he came out, U.S. Treasury calmed down. People stopped the sell America narrative. But Japan, I think we need someone like, the Scott Bessent moment that can actually communicate with client and close that gap, right? Because Japan doesn't have a funding problem. Recall, 90% of Japanese debt is funded domestically, period. So there's always buyer, right? The only thing matter is timing and yield level. Pricing, right?
On the yield, I was going to ask you about credit, but on the yield level on JGBs, so for the longest time, the debt burden was not an issue because it was locally owned. But at these levels, do you think it becomes a problem in terms of just being able to service that debt? And sure. I just want to ask you too, is there any value right now across this JGB curve that you would be advocating investors to dip by? Sure.
I think to answer your first question regarding the servicing costs, right? Right. You have to look at liability versus assets, right? Recall Japan is one of the biggest creditor in the world, right? Next external assets is $3.7 trillion, 3.7 fluctuates based on FX. But the whole point is you're getting a lot of high coupon, right, on that $3.7 trillion, which is actually offsetting the servicing cost Japan is paying.
Okay.
Right. So I think squaring everything out, net for now.
No effect?
No effect.
Okay.
Right? And your second question regarding the yield level, attractiveness, I think it's pretty attractive at current level, right? Look at 10-year in JGB is trading at 2.5, right? And we started seeing real money, banks, insurance companies coming out saying that they will buy from when yield is 2.5 to 3%. That is real, right? People coming out recall Japan, the banking system has $400 trillion of liquidity, have cash, right? It's a matter of time they come to buy. Why are they not buying now? Because they're waiting for BOJ to hike to terminal, and then no one wants to catch falling knives in Japan, especially, their salaryman mindset. But when you get volatility subsides, that's when they come in, and that will be a 2026, late 2026 story.
Gold, though, has still been reflecting that shift away from sovereign bonds, currencies, concerns about Fed independence as well. So now we're at 5,500 an ounce. It's pretty crazy. What do you make of it? And would you actually find it attractive at all as an asset right now at these sort of levels?
I'll give you a very good anecdote, right? So I've been traveling in APAC, speaking to clients. I was in Taipei yesterday, right? There's never been so much discussion regarding gold from every single investor. Real money, long only, the big asset owners. I think it's a rebasing of prices, right? Going up to 5,500. The whole point of gold is there's finite supply, right? Limited supply. But when you have demand coming in, especially from central banks, and also there's a lot of ETF flow coming in. So at State Street Investment Management, we run the biggest gold ETF in the world, GLD. We have been seeing flows coming in from, across the spectrum, right? Different investors. So we think that, whenever gold dip, right, is the mentality now is to buy on dips instead of, sell, take profit when it goes higher.
Okay, yeah.
All right, Masahiko, great to see you again at the start of the year. That was Masahiko Liu, the senior fixed income strategist at State Street Investment Management, counting down, of course, the open of trade in Shanghai, Shenzhen and Hong Kong. Futures pointing to a little bit of weakness here, also taking a look at the yuan reference rate at the bottom of the screen. We'll have more ahead. This is Bloomberg. You're watching the China Show this morning, taking a look at what we're going to be keeping an eye on today in the session. So we've got Keir Starmer, of course, the UK Prime Minister, in China to meet with President Xi Jinping later today. Also, lots of focus on the metal space in particular, because you've got Goldman Sachs saying that the base metals rally is at risk on weak Chinese demand. But of course, precious metals is quite a different story. And we've actually got the first ETF that's going to give exposure to mining companies listing in just a few minutes from now.
Yeah, we have a couple of things to track, of course, and as you look at that, I mean, it's not like we are not yet spoiled for choice on proxies to get exposed to the gold play. So one, of course, is today, the other one is tomorrow. Amidst the market that is pulling back a little bit following, I should mention, quite a very, very good day in the equity markets on Wednesday. So the opening bell plus this debut today coming up. This is the China Show. All right, welcome back. You're watching the China Show. We're looking at the Hang Seng Index 7/10 to 1%. A couple of other things. Well, just to mention what you're seeing on your screens, of course, it's a gold ETF here in the city. Why not? With spot at 5,500, right? We have, I think, one more tomorrow, which is a different iteration and different type. Apart from that, so gold is up. I think silver spot is closing in 120. You have this massive bounce in the dollar following comments coming out of Scott Best. We haven't talked about the Fed, but there was really nothing as far as the Fed was concerned. So I guess we can set that aside for now. Tech is a big thing too, though, although it's largely a non-China store, at least these earnings specifically.
Yeah, I mean, the memory chip price theme, I think, is consistent and something that will have a bearing on some of the Chinese electronics makers, for instance. And you've also got prominent Chinese memory chip makers that could be looking to list in Hong Kong later this year. But in terms of the market activity today, it's sort of, you're just seeing it moving a little bit higher at the open. It has been, well, we did see some southbound selling yesterday for a fourth straight session, but overall, Chinese equities have been moving higher across the board. And you're just seeing, again, lots of green here across the screen this morning. morning. Big focus on what's happening in the metal space. Actually, Goldman Sachs is out with an interesting note, and they're saying that the base metals rally is at risk on weak Chinese demand. So you could be looking at headwinds from some of the manufacturers in that space.
What a bummer call from Goldman.
Well, it is. I mean, gold, you can always look at gold, for instance,
That's
hitting
right.
5,500 an ounce
I
this
banter,
morning.
of course, our friends at
Yes,
Goldman.
yes,
but
yes.
Go ahead.
All right, let's take a look at what's happening in Hong Kong today because, again, the focus, you've got those ETFs, that gold ETF making its debut, of course, or starting to trade. But broadly, we are looking a bit to the downside. Actually, tech space is interesting to watch today because you're already off more than 1%. And it would just be interesting to see any sort of read across. As we said, memory chip prices is something that's going to be having a big bearing this year because you've got SK Hynix, Samsung, the big beneficiaries out of that. But certainly, the more they ramp up their HBM production, the more it has an impact on the wider DRAM market, NAND prices as well. There's lots of flexibility for those suppliers in terms of how they set their prices to their customers. But we are just seeing that down across the board today. Tesla supply is also in focus. I think this is a very interesting earnings report from Tesla because they're actually pulling back on how many EVs they're planning to manufacture in terms of their different types of EVs, but also they're continuing to make that shift into AI, into robotics in particular. So they're asking investors to be pretty patient with that. We are just taking a look at some of their supplies. They're pretty mixed moves so far. Another company to track as well because we've got Mu Yuan Foods here. This is one of the world's biggest pig breeders and pork producers. And, watching their listing there, but they're seeking up to $1.4 billion in that. So it's going to be their second listing in Hong Kong. Could raise as much as 10.7 billion Hong Kong dollars. And then also, David, still tracking what's happening in the metal space, as we said today.
Yeah, I still recall it was a few days before Christmas, and we were seeing calls on silver at 70, and folks were saying, you know what, that looks a bit expensive. Silver was toppy at 70. Well, guess what? We're at 120 now, and we're barely about a month from that call. As we were pointing out, right, so spot gold hitting a fresh record today. Don't sleep on this pickup we're seeing in the commodity space with Shanghai crude, of course, following that move that we had on Brent, which at 69 effectively puts Brent crude at the highest since late July. But yeah, let's circle back to gold because why not? Everyone is scrambling for anything that resembles gold these days, right? Everything from ETFs to actual jewelry to miners. It was a very big topic of conversation during AFF when this gold. Hong Kong as a gold trading hub came up quite a lot. It's a priority of the government. I think there's a gold vault that they're talking about at the airport, which is 50% of the capacity. And then the other 50% is obviously they can't tell us where that gold vault is going to be. But suffice to say.
We can look for clues.
Yes, we can look for clues. We know who to ask, but they won't even tell us, but it's okay. Just on that story, right, they're also looking at bolstering the trading platforms on the exchange. I think we heard from Bonnie Chan. Equities has been a very big part, IPOs and everything else, commodities like gold futures. And today, we just showed you, of course, that live pictures coming out of the exchange. Hang Seng Gold ETF here in Hong Kong today. This is the latest offering, in fact, for investors that want to get exposure to the bling bling. Now, joining us here on set, Rebecca Sin, our ETF analyst, to talk us through this one specifically today. What are we getting into today, and how much is it going to cost investors too?
So this is the 5th gold ETF that's listing on Hong Kong Exchange. After tomorrow, there will be 6. But Hang Seng has listed a physical gold ETF at only 40 basis points. So this is the cheapest gold ETF that's available. But what's unique about this ETF is that you can redeem it back in physical gold. So you buy the ETF, and you can go to Hang Seng Bank and get physical gold back. And so this is the only ETF that offers this unique feature. And because it's done by Hang Seng Investments, you can redeem the ETF at the bank and get a physical gold back. And so this is very, very interesting because we've never had an ETF like this. It's only 40 basis points, 100% backed by physical gold. And as you know, gold is up 28% in just the past 2 weeks.
Exactly. So
it's crazy. That statistic still blows my mind.
It really does.
Right?
It really does, because even we were talking about 5,000 and 5,000, now you just blow right past that to 5,500. I mean, what are the flows then showing us around gold in general?
So gold is at a record level. And normally when you see an asset class hit record level, you expect some outflows, people to profit take. But we've actually seen the opposite, which was very surprising. So year to date, we've seen roughly $16 billion in assets go into gold ETFs globally. And so this is a record number. And what's interesting of this is if we look at the top 10 ETF inflows for gold, 5 of them are listed in mainland China. So this just shows you how much demand there is coming from the region. And historically, as Federal Reserve increase rates, you often see gold prices go up. And so this year, no surprise there that we're seeing an increase. But as central banks have been increasing their gold reserve since 2022, the top holders of gold after the U.S., Germany, is really in Asia Pacific. So you have mainland China, Japan, and India as the top holders of physical gold. And so from a flow perspective, we're hitting record numbers. People are increasing. And so this ETF is very timely in that it's at where gold prices are trading and the flows are both at record level. And one thing that's unique is I think Goldman Sachs mentioned this week that they expect gold to hit around 5,500 to 6,000. Bloomberg Intelligence expect gold to stay around the 5,000, so above 5,000 this year. So it's very timely for this ETF, and it should do quite well in the region because, one, Asians love gold. Gold is oftentimes an asset class, and the mainland China is the 3rd largest holder of physical gold.
Okay. Rebecca, thank you so much. Rebecca Sin there, of course, who looks at this space very, very closely. Our ETF analyst. What a time to be alive when you look at this gold ETF. Okay, we're looking at the benchmark right now. We're about 7 minutes, going on 7 minutes to the cash market session here. CSI 300, MSCI China, Hang Seng Index coming up on your screens. When you look at these numbers, just keep in mind, I'm going to bark out some other numbers too. 30,000 on HSI. 5,300 on the CSI 300, and 99 on MSCI China. Those are the targets coming through out of Citi on the benchmarks for 2026. Joining us here on set to talk us through those calls and how you express those trades. Joining us here is Pierre Lau, China equity strategist at Citi Research. Very nice to see you.
Nice meeting you.
So, bullish, looking at the targets themselves. How are you looking at market leadership this year? What are the places to be in?
Well, this year, 2026, is a special year. It will be the first year of our 15 5-year period. So the first thing that we should look at is the 15 5-year plan. And from that perspective, we are more positive to some sector like tech. Okay. And then secondly, export is still something that we are very interested in. China is a big country. It's not easy to be replaced by other countries because China has a lot of industry with very comprehensive value chain. And also we have high degree of automations. We're using more robotic, so that also boosts China export. And then thirdly is basic material. You mentioned about gold a moment ago. Yeah. So basic material is also an area that we are seeing continuous earning upward revisions. So these 3 aspects, I think we can be more positive in 2026.
And drilling down into tech in particular, which areas of the market stand out to you?
Well, tech, there are several different sectors. You can divide them into a semiconductor, the telecommunications, software, hardware, something like that. The area that we are more interested in are semiconductor. The reason is that we are expecting China or the Chinese government want to have more localization to support our semiconductor development. Obviously, over the last 5 years, China have a lot of obstacles in terms of bringing or importing high level of semiconductor into China. And that's why the Chinese government want to have more self-development, research and R&D so that we can have more local supply to ease the bottleneck. That's also the area that you can expect more policy support. And for stock market, obviously, we want to have more government support in terms of the area that we are interested in. And semiconductor is the things that we like.
Okay. On a benchmark basis, I'm curious, what is the earnings forecast from Citi as far as growth? And the bulk of that will be coming from what sector specifically?
Earning growth this year will be exciting. We forecast that the EPS growth for Hang Seng this year will be accelerated to 9.1%, much better than 2.2% last year. And the biggest earning upward revisions come from 2 aspects. One is from the internet sector. Internet sector, you might recall that last year there were a lot of competitions, in particular related to food delivery business. Yes. So some companies, they have earning cut last year, but this year we expect that they will resume having earning growth. Obviously, they will have a lower earning base from the poor performance last year. And the other area that we are seeing continual upward earning revision is the basic material, where it is related to copper, aluminum, gold, silver, etc.
Interesting on that, because Goldman, as we've been discussing, this call out from Goldman Sachs, but they're actually saying that the rally that we've had in base metals could face headwinds essentially, but softer demand may come across from China. So you don't see that being the case?
Well, I think for demand from China, we are talking about some specific area. For example, we are not talking about all kind of basic material to have increase in prices. For instance, if you talk about steel, cement, property market in China are not very good, so they are not booming at the moment. But other area, we talk about copper, aluminum. These are the area that you can see a lot of demand, in particular for power grid development, infrastructure development. We are having accelerated electricity demand growth globally. So that's why I think for some type of metal like copper, aluminum, the demand will remain strong.
There was a research note from internally earlier. I was reading it. This, as an example, this rise in silver prices might hit solar, for example, that uses some of that metal. And I'm curious, someone else's earnings become someone else's margin compression, right? So this pickup in commodity prices, are there specific sectors where you think margin compression is something we need to watch because of that cost pressure?
Yeah, that's a very good question. So we are expecting margin cut in some areas, such as for energy storage system producer, because of increase in battery prices, result from higher lithium prices. And then for other areas, like you mentioned, the solar panel maker, because of increase in silver prices. And these makers are now trying to use less silver so as to reduce their cost. But I think it's difficult to offset all kind of increments. And some other areas, for instance, the coal-fired power plant operator, they are also facing increase in coal prices, etc. So that's why there are quite a number of sectors that we are seeing margin reductions in first half this year compared to second half last year.
What's your thinking around where the Chinese yuan goes as well?
You mean exchange rate?
Yeah.
Exchange rate. We are expecting RMB to appreciate versus US dollar this year. But the interesting thing is that if you look at what happened last year, RMB also appreciated versus US dollar, but depreciated versus some other currency like sterling pound, Australian dollar, etc.
That's right.
So that's why we don't feel that because RMB will appreciate versus US dollar, that would affect China export a lot. China export now has become much more geographically diversified. Last year, only 13% go to the US, and instead the biggest two regions are Southeast Asia, around 17%, and Europe, 15%. And that's why, despite we are expecting RMB to appreciate versus US dollar this year, we are still confident to China export.
So I think three things have stood out in terms of, the three areas to be in, right? So as you point out, it's almost the same as last year. Tech, you have materials, and maybe financials because of the dividend. So I'm curious in terms of if the soft parts of the economy start to improve, right? So things like consumption and housing. Do you think the market will rotate as far as market leadership is concerned beyond what's really been the bright spot, which is tech and everything that we just talked about?
Well, I also hope the weakest links to be improved, but this time, in fact, you can see that we are still cautious on consumer. About 70 to 80% of the consumption are still from those old economies. So that's why I think for among the consumption play, maybe only those related to new economy have better growth, but not the others, older one. And property sector, we are still cautious because high inventory in China. Hong Kong may be a bit better. And hence, I think the investment tone for 2026, we are still more niche-oriented. So that's why we focus on the 15-5-year plan, we focus on export, we focus on basic material.
Pierre, fantastic. Thank you so much.
Welcome.
Let's talk again soon. You guys are just across the street, so quite an easy trek. Easy. Pierre Lau there, China equity strategist at Citi Research. Coming up here on shows, Prime Minister Keir Starmer is set to meet President Xi Jinping in Beijing today, pledging to pursue a more mature relationship. We'll look at what's topping his agenda coming up next. This is The China Show. Welcome back. You're watching the China Show. UK Prime Minister, there he is, or there he was at least, of course, coming through as on his arrival into China. Keir Starmer promising to seek a more mature relationship with the Chinese. That's ahead of talks today in Beijing with Chinese President Xi Jinping. Min Min Lo, our China correspondent, is here to talk us through the initial positive tone coming through here out of Keir Starmer.
Yeah, a very positive tone right from the get-go. One of his first remarks was with the delegation that accompanied him. So he spoke at the lobby of his hotel, telling the delegation that they are making history as he's embarking on this change. He has said before he's trying to end this so-called ice age that the Tory government has brought about with China. And he's really trying to go on this two-pronged approach, right? On the one hand, he is acknowledging some of the national security risks or threat that China is posing, but on the other hand, also saying that UK needs to do the responsible thing and continue to engage with China, even if they disagree, and especially because the UK economy is shrinking, it's experiencing high inflation, and he really wants to improve those investment ties and trade links with China. What could be expected, though, on a concrete basis, because this is going to be a bit of a test as well? Yeah, so we'll be looking out for size and scope of any sort of trade deal from this trip. Analysts are not expecting any comprehensive free trade agreement because of potential retaliation from President Trump, but we could see piecemeal agreements, company-to-company agreement. We are already expecting at least one energy deal between the top power company in the UK entering into a strategic partnership with a Chinese power company to start building a power trading platform, and that is an important foray into a sector that for a long time has been highly regulated. So there are trade agreements, climate change areas we're looking at. Of course, the other bucket is the geopolitics, right? Ukraine, Taiwan, Jimmy Lai. These are areas where we're not likely to see forward progress. But another symbolic move that China could possibly offer is also visa-free travel, something to watch out for, because this would then put the UK on par with many other countries that increasingly are enjoying visa-free travel to China. Yeah, it'd be interesting, of course, because China's exports to the UK hit a record last year as well. So any kind of concerns about exporting overcapacity or how they get around that. But that was our Bloomberg China correspondent there, Min Min Lo. And we've got lots more ahead, actually, on Keir Starmer's meeting with Xi Jinping coming up today. We have the China-Britain Business Council Chief Executive, that's Peter Burnett, who's joining us from Beijing in just a few minutes' time from now. More ahead. This is Bloomberg. Here are some of the stories that we're following this morning. Senate Democrats are demanding new curbs on President Trump's immigration crackdown in exchange for their votes to avert a looming US government shutdown. The demands include restraints on use of force, a ban on masking agents, use of body cameras, and better cooperation with local law enforcement. Anger's grown after ICE agents shot and killed 2 people in Minneapolis. President Trump has warned Iran to make a nuclear deal with the US or face military strikes even worse than last year's. In a social media post, Trump says the fleet he's ordered to the region, led by an aircraft carrier, is ready to fulfill its mission with speed and violence if necessary. Iran's UN mission responded on X, warning if pushed, the country will defend itself and respond like never before. Canada says energy and critical minerals will be the cornerstone of new trade ties with India. That's as the two nations rebuild ties or relations after a diplomatic rift. The Canadian Energy Minister spoke with Bloomberg at India Energy Week in Goa. That's about their deal to expand trade in oil and gas. Here's what he had to say about India's growing power demand in a great opportunity, for Canada.
In the process of significantly increasing our export capabilities in critical minerals, in LNG, in LPG, in conventional oil, in uranium. We're meeting with your company so that they understand what's happening in Canada, and we're laying the framework so those private sector companies can do the transactions.
One market we're tracking as things get underway in the next hour, in a couple of minutes effectively, will be Indonesia, following one of the worst days on price. 7.3% to the downside. I think the single biggest day since, of course, April of last year, Liberation Day, but it's really on par really with some of the worst days. COVID hit, you had the global financial crisis coming through. You had the Bali bombings in early 2000 to the Asian financial crisis. So similar drop in terms of the price moves. Of course, it was just one day, so we'll see what happens on day two. Some of the big players and the big banks and the big stocks, of course, that really took a massive hit on the back of this MSCI warning. And of course, they're giving them some time to maybe address some of those issues. UBS coming out and saying they've underweight. Of course, they've cut Indonesia stocks from neutral to neutral from overweight. And just in terms of market cap, the data has just come through. Nearly 80 billion in market cap was wiped out. That's a record amount because the market is, of course, much, much bigger today than it was a couple of years ago.
Yeah, but they've got that timeline, as you said. They've got to have made these changes by May of this year. So you do have that sort of countdown now. It's just the problem is a lot of these issues, like things like tightly held ownership of listed companies, could take months to resolve as well. But more ahead, this is Bloomberg. Welcome back to the China Show. Taking a look at the Hang Seng half an hour into the session this morning. It is very much a down arrow story. So we're seeing losses here across the board. But actually, if you look at the 80 constituents, around 3 and 4 are in the red this morning.
Okay. So decent amount of negative breath. Actually reversing almost a mirror effect of what happened yesterday. I think we ended up 2.5%, if not more, in the Hang Seng. In fact, still at these levels with the declines, we're still above the trading range in recent months. So we have managed to break above that, and we'll see if we manage to hold above it in the coming days as we approach, of course, the long holiday that's coming up in about 2.5 weeks from now. Just a glance at some of the sectors we're tracking early on. Rare earths, and as you can see on the screens, you will see on the screens very shortly. On the up, some price support out of the U.S., or less price support to qualify that out of the U.S. We're looking at casinos too. Should be declining today, maybe across the board. Let's get that up just so we can see that. So the parent of Sands China to Las Vegas Sands, of course, fourth quarter numbers showing profits in Macau specifically missing analyst expectations. So that's unsurprising, that stock among the rest, of course, feeling the biggest pinch there today. One market that is coming online, we're focused on this, 7% drop into the close. We're down to 4% in Jakarta this morning. The latest, UBS downgrading the market from overweight to neutral following the call coming out of Goldman that's come out there. MSCI, of course, coming out with some concerns. They're giving regulators a few months to try and address that as we try and get to understand really what that means and whether or not they will be able to meet that timetable. Keep in mind, this market has also rallied quite substantially in recent years. Investors are selling first and they're asking questions later here, Belle.
Yeah, it's quite crazy, though, that Indonesia is a top story for us today when you think about we're also coming off a Fed decision and it just sort of...
Oh, that's right. That was today, wasn't it?
Tells you, I mean, maybe it's just we're calling it a bit of a non-event, exactly. But still, just to recap that decision, so it was another hold essentially, but approved on a 10-2 vote. So 2 dissenters. We had Governors Chris Waller, Myron as well, but Powell citing a clearly improving outlook for the US economy, and then signs...
Which is a good thing.
Well, that is a good thing, and then signs that the job market, rather, is stabilizing.
Yeah, so I think you had that hold and the guidance that maybe no cuts for the next few months, and then you had separately the comments coming out of the U.S. Treasury Secretary around the dollar, and to rephrase how our guest in the previous hour mentioned, did a bit of damage control, of course, compared to, I think, what the damage we saw in the dollar following the U.S. president's comments of, the weakness is not something that disturbs him, just to rephrase that too. Okay, apart from that, tech earnings, of course, is literal confluence of big earnings coming through out of the U.S. And in the Asia Pacific, the two big Korean companies, of course, also came out with their results there, Belle.
Yeah, so we've got to get to SK Hynix and also Samsung, because these two are basically neck and neck when it comes to HBM in particular. So SK Hynix has been the leader in HBM so far, but we're at HBM4 now, and they're actually saying, SK Hynix, that they're into full-scale production of their HBM4 product. That's Samsung, rather, that's saying that. Also, Meta, Microsoft, Tesla, IBM, all of the other numbers. But I think we just got to get back to Indonesia, given we're seeing that stock benchmark essentially just extending its route this morning.
Yeah, okay, so we're looking at a further 5% drop on the benchmark itself. In terms of negative breadth, the majority of stocks are, as you can imagine, on the way down. So at these levels, we'd be entering a technical correction on the specific benchmark just after 2 days. We're now down 13.5% from the peak early this month. Let's bring in Lian-Ting Tu now. In fact, she's standing by to just take us through how we're looking at the market today following just the absolute collapse in prices and the wealth destruction that's taking place there in Indonesia. Lian-Ting, how is your team looking at this today, day two?
Yeah, it's rather shocking. I think after having 1 day to digest the MSCI news, investors, as you guys were mentioned from the sell side, actually, UBS and Goldman Sachs both came out to downgrade Indonesia markets, and Goldman actually put a specific number on the potential outflows if Indonesia indeed was reclassified from emerging markets to frontier market status, and the number possibly the big number is $8 billion worth of outflows, and that is just a passive side from the MSCI. But FTSE also has their Indonesia index, and if MSCI made that decision, we are expecting to see almost $6 billion from the passive flow tracking the FTSE index. So there is a lot of money at stake right now, and if you look at just the overall sentiment, I think people are just now really being reminded that Indonesia's free float or concentrated shareholding is really a big governance risk for not just the local but especially the global investors. And the ripple effect could be going into the bond market as well, because in the bond market people are also looking at the governance issue, central bank independence. So if the equity ripple goes into the bond market, then we'll see a whole lot of global fund manager outflows.
Yeah, on that point, because we know that Indonesia has this deadline, they've actually got to have made sufficient progress by May, and you think that's really only 4 months away. It's not that much time, really. So just how widespread does the damage get from here, and what sort of further losses are investors expecting, do you think?
Yeah, I think right now it's just panic selling, right? We don't know, how long it will take for the panic stage to finish. But, for the people that we're speaking to right now, a lot of people are actually cautioning against buying the dip, right? And holding on to only the blue chip, best quality names. So I think right now we'll probably see a couple more days of selling. For MSCI, I think, the Jakarta side, the government side can actually do something to stem the losses. For example, they could come out to say that we're going to up the bar for free float requirement. Currently, it's at 7.5%, and that is really low compared to the neighboring countries like Thailand, 15%, or Hong Kong at 25%. So sort of an immediate decisive step taken by authorities there could possibly revert the sentiment.
So aside from Indonesia, aside from the gold rally, aside from the dollar story as well, tech is the other big theme that we're tracking today. Lots of earnings out from the US. We had them from Asia as well. What themes are attracting most of your attention today?
Yeah, today is a big profit-taking day on tech. Of course, you guys were mentioning SK Hynix, Samsung both had blockbuster earnings, and Meta earnings not bad, and even Microsoft announced a big capex spending. So net, all these capex spending from the US hyperscalers should really benefit Korean and Japanese and Taiwan sort of infrastructure, the kind of tech gear makers. But right now, because it's also the month end, people are looking to lock in all these gains. So this is the result season provided that kind of opportunity, and we only have one trading day left. So I think from today and tomorrow, we'll probably see more downside risk.
Lian-Ting, thanks very much for joining us this morning. That was Bloomberg's Lian-Ting Tu there. And I think what was a really interesting thing that came out of the earnings, and you sort of heard that being referenced across a couple of different calls. You heard it from Microsoft, for instance. You heard it from Tesla, the boss as well, Elon Musk. It's that memory chips are actually becoming a bigger constraint than AI chips. That's exactly what Elon Musk said in the earnings call. So it just really goes to that story of SK Hynix, Samsung, how we could be entering even a multi-year cycle now for memory chip prices to go even higher, essentially. But taking a look at some of those Tesla suppliers in China, because we did have overall the EV maker reporting some better than expected numbers. So it's also saying it needs to build a chip factory of its own, and it's mapping out $20 billion of investment this year.
Yeah, the EV pioneer, of course, also revealing plans is $2 billion investment in XAI. In fact, Danny Lee, our transport reporter, is here with us to talk to this transformation, of course. Danny, now Tesla is looking less like a pure car company and more like an AI play. Just help us through the language that's coming from Elon Musk on that front.
Yeah, that $20 billion that they're looking to spend this year is going to be a huge investment that the CFO of Tesla had outlined. And it's actually a surprise to the markets because they were expecting an investment on CapEx of around half of that number. And so, as you said, that pivot to focus on being a more autonomous AI-driven company, they're going to be spending on 6 new production lines. So things such as its refinery, on the Cybercab, on the Optimus robot, and earmarking money on XAI as well. So there's a lot of focus on that, on stuff like robo-taxis that will drive it towards that future and to support the valuations that the market is seeing it as. But then also on top of that, you see it's paring back on these EV products. It's streamlining its products. So it's going to be getting rid of the Model S and the Model X. These are 2 low-volume, high-priced products that the consumers probably don't really need or want. And so therefore, it's going to be doing away with that and therefore doubling its efforts on other priorities that will see its future to be a more kind of autonomous driven firm.
We did see the stock move higher in late trade. Why was that exactly? One of the things I find curious about Tesla is that you're taking away the number of EVs that you're going to have for sale. You've already got to grapple with a slowdown in the EV market and consumers preferring other ones. At the same time, it's intensely competitive in the humanoid space. It's intensely competitive in the AI model space as well. So why do investors like that narrative around Tesla to that extent?
I think in the short term, the fact that Tesla was able to break its decline in quarterly profitability. So there is that momentum, seeing that results look a little bit better than expected. Clearly, when you look at the future, Elon Musk has said that the only competition he sees in the humanoid robot space is from China, and we've already seen what China has done on the EV side of things. So I think for the meantime, the fact that these results were a lot better than Wall Street had expected, given the loss in some key revenue streams around subsidies on EVs, this is not too bad, even though we saw its first ever decline in annual revenue. So I think there is optimism, even though Musk is going to have to spend a lot, or Tesla is going to have to spend a lot. It still has $44 billion in cash investments to fund that $20 billion it's going to be spending this year. And of course, who knows how much more it's going to have to spend if it wants to build its own semiconductor factory.
Danny, thank you so much. Danny Lee there, our transport reporter. While Danny was just talking there, we were just monitoring as well simultaneously this massive rout in Indonesia, which is gaining traction right now. Down over 6% now on the benchmark. We have just taken out the 7,800 on the JCI. This chart that's coming up on your screens will just highlights the magnitude and the velocity of this drop in the benchmark itself over the course of just, let's call it a little over a full trading session, because we're just 10 minutes into day 2. We've cut through 2 moving averages. We are about to take out the 200-day on the JCI over just 2 days. And we are set to enter a correction. Anything more, slightly more, so we're down about 14-15% from the recent peak. We're a bad day away from this one entering a bear market over the course of just a couple of, just to underscore how quickly things have unraveled here in Indonesia.
Yeah, and certainly in this environment of panic selling, that seems very feasible. But we'll have more on that, of course, ahead. And in the meantime as well, we've got the UK Prime Minister Keir Starmer set to meet President Xi in Beijing later. So we're seeing that pledge rather from Keir Starmer to pursue a more mature relationship as well with the mainland. We speak live next to a member of the British delegation. This is Bloomberg. The UK Prime Minister Keir Starmer is promising to seek a more mature relationship with China. That's ahead of today's talks in Beijing with President Xi Jinping. Starmer told a delegation of some 60 leaders of British businesses and cultural institutions that the UK has a responsibility to repair ties with China.
Let's bring in Peter Burnett, Chief Executive at the China-Britain Business Council, which is part of Starmer's delegation, of course, as we enter the first full day of activities. Peter, thank you so much, and good morning from Hong Kong. Suffice to say, expectations are on the higher side relative to recent years. Help us manage expectations, realistically optimistic. How would you describe the specific delegation as this trip?
I think it's pretty optimistic. We've got around 60 delegates here from 60 different businesses, ranging from the very big, the HSBC, AstraZeneca, the pharmaceuticals, all the way down to, some smaller companies, Brompton Bikes, for example, which has a very big business in China. And then there's this cultural delegation as well, which I think is pretty important. So representatives from museums, from art galleries, from performing arts, from opera, from across the spectrum of activity in the UK.
We have seen British companies concerned about things like opaque cross-border data rules. There's been tariffs in certain areas like whiskey, for instance, some restricted access. What would be some of the top wish list items then that the businesses that you speak with would actually be looking to achieve?
Yeah, we would love to see tariffs come down, and I hope we will see some announcements on that. We can't preempt any of that because those announcements will happen, I think, later today and tomorrow. But I mean, clearly, access for the whiskey business in Scotland, which already has a sizable market here in China, would be very, very helpful. But it's not just whiskey. I think if we can move to less friction in services more generally, greater market access, because services is a big component of the UK economy. It's been recognized in the 15th five-year plan as a growth area for China. So there's a very natural combination of the two, if you like. And I hope we see, we probably won't see, full announcements on frictions being lifted, but we'll see some progress, I hope, towards a possible dialogue around trade and services. And services is
We're
not
just
just
showing a
financial
chart.
Sorry, carry on.
No, continue.
No, I was saying services is not just financial services and legal services and accounting services and consulting services, but it does include the creative industries. It includes hospitality. It's anything which doesn't, require you to send a good or a product across border, a physical item.
We were just showing a chart there, Peter, looking at the trade surplus with Britain, because essentially that hit a record last year, and there's lots of Chinese products that are essentially entering the UK market. Is that a concern at all that British businesses are also bringing as part of this delegation?
Well, I think the British delegation would like to see more exports of their products into China. There's no doubt about that. And hopefully some of these frictions that can be removed to provide greater access will be part of the arrangements. But at the end of the day, I don't think there's a huge amount of concern about the imbalance. The UK exports about 45 billion pounds worth of goods to China every year. It's the relationship, the total trade relationships makes China-UK the third largest commercial trade relationship after the US and the EU. So it's an incredibly important relationship and an opportunity to expand more. And it's a little known fact that actually, coming back to the services question, the United Kingdom actually has a surplus in trade in services with China. And the fact that the Chinese now want to open up services and develop services for their domestic market, I think is a huge opportunity for growth in the services industry for the United Kingdom.
Peter, part of the relationship has really been, let's call it, in the past, more robust people exchanges. And, a lot of Chinese students call the UK, of course, their home. And, I wonder, in terms of the flow of students to some of, Britain's finest institutions, how much of that is a feature in these talks right now? Because I imagine some of them are part of your council. And what is the outlook as far as the flow of students are concerned?
It still remains pretty positive. I think the UK has been a beneficiary from policies in some other countries around the world to close off or to reduce access to tertiary education. It's a very welcoming, the universities are very welcoming to, not just Chinese students, to be honest, but the Chinese student cohort is very large in the United Kingdom and a very important component of the way universities function today. I don't really see that declining. You have to be a good university now. You have to be sort of in the top 100 or so to be able to attract those students. But the other very interesting development is this transnational education as well. So these are universities in the UK that are now moving and setting up campuses in China. And that is, I think, a developing area for tertiary education. So we've seen it in Ningbo with Nottingham University, in Suzhou with Liverpool. And there are more of those, I think, potentially coming. And that allows, of course, Chinese students to get an education, a tertiary education with the UK qualification, but not to leave China. So, I think that's becoming a more attractive alternative.
And Peter, what about the other side in terms of the British community in mainland China, whether that's expats, diplomats, students, tourists, and maybe along the same lines of that question, do you think we will get visa-free access announced at some point today?
Well, that is the big question, and we've got all our digits crossed. The UK is an outlier at the moment, and we would definitely welcome that. And the conversations I've had with Chinese officials at Ministry of Commerce, for example, they are fully supportive of this next step. But of course, it's not in their gift. But anybody involved in commerce, anybody involved in business, obviously wants to be able to see a freer flow of people cross-border, particularly in the business community, because that's the way you get to know each other. That's the way deals get. And it's certainly true for SMEs, who want to come to China. They need to be able to turn around very quickly and not have the restrictions on visas. So fingers crossed.
Okay, all digits are, as you were pointing out. Peter, thank you for spending some time with us this morning. Peter Burnett, their Chief Executive at the China-Britain Business Council in Beijing, ahead of a very busy agenda by the looks of it here on the ground there. Just very quickly, we'll pivot back to Indonesia, where the market rout, as you can see, is extending even further. We're now down 7.6% on the benchmark. You couple that with a similar loss yesterday, let's call it over 15, maybe 16% at this point here on the JCI. So over the course of 2 days, we've taken out the 50, the 100, and just now the 200-day moving average on the benchmark is that we are poised to enter a technical correction. A little bit further, that actually could become a bear market. We'll see what happens. Plenty more ahead. Right, welcome back. A check of markets in the Philippines. So this one opened, of course, an hour back. About 25 minutes or so, we had the GDP numbers coming through. And as you can see, it's still growing, but it was quite a miss relative to estimates. Second time, actually, that it's missed estimates. And at 3%, if you think about it, that's about a 3-4-year low as far as growth is concerned. They've also lowered their GDP targets for this and next year explains why things are underperforming there in Manila today.
Yeah, what's outperforming, though, is actually China property stocks, because we have been seeing those gain today. It's a story or some reporting we're getting from Beijing News, and they're saying that developers will no longer be required by the regulator to submit monthly so-called 3 red lines indicators. There's quite a few details to that, but essentially it's policymakers that introduced debt metrics in 2020 that set limits for developers seeking to borrow more. So essentially saying that those have been removed now, according to local media. But you are seeing, of course, a very outsized reaction so far in the session today. More ahead. This is Bloomberg.
All right, we're about 30 minutes into day 2, and it's not looking good. In fact, at this current level of price losses right now on the JCI, we're actually in worse shape compared to day 1, where we did manage to close, relatively speaking, of course, just over 7% down. We're now down 8% as far as trading halt, of course, there. And yeah, things are just, pardon my French, just getting tossed out the window today, following what was already a record wipeout on market cap yesterday, right? So in terms of just the size of losses on a monetary basis, close to 80 billion in market cap was wiped out on Wednesday. We'll have to wait a further day or two before we get the damage report for today, but suffice to say, we've cut through 50, 100, 200-day moving averages, and it looks like we are set to enter a technical correction after just 2 days here.
Yeah, I was interested with your part of my French, because I could have thought of a way more colourful expression to describe what's happening in Indonesia.
We're on live TV, but yes.
Yeah. But no, it's a big question, of course, because they've got to be making these reforms by May of this year. So is that possible? And right now, you're just sort of seeing panic selling, essentially. The question is, I guess, how far lower we go from here, given that a lot of the investors Bloomberg's been speaking to are saying this is not a dip buying opportunity.
Yeah, absolutely not. Yeah, don't. I don't need to lay out what the French is really. I'm saving that really because I would imagine everyone on the ground invested in this market is probably saying a lot more fruitful ways to describe the price action today.
Let's get more of that now. Bring in Mohit Mipuri. He's senior partner at SGMC Capital. So Mohit, you're someone with direct exposure to Indonesian equities. So what exactly is your initial reaction to this, and as well, how are you riding out the storm?
Thanks for having me, Annabelle and David. I'll also pardon my French today on live TV. What we're seeing in Indonesia today, it's not a macro shock. I think that's something I want to highlight. It's an index and technical shock, as you've pointed out. Yesterday's sell-off and today's is driven primarily by MSCI placing Indonesia on probation until May, as it reviews how this free float is calculated. So this has obviously unsettled markets because it introduces uncertainty around potential passive outflows. Not because Indonesia's fundamentals has suddenly changed. So in terms of reviewing it, am I panic selling? No, I am not panic selling. I think historically in the past, if we have seen even September 2025, when we've had massive index shocks, investors have actually been rewarded for stepping in. The monthly, I mean, you've highlighted the 200-day moving average, 100-day being breached, but actually on the monthly and quarterly, all the alignment on the index is still a buy at the moment. So I would like to see 7,500 on the index hold before reacting into any further.
Okay, so Mohit, just to clarify, you haven't sold anything since yesterday, just to close the loop specifically on that one.
No, I haven't sold stocks since yesterday. But having said that, I think the last time we came on Bloomberg back in September when the Purvaya was stepped in, we were aggressive buyers back then. So we were sitting on relatively good gains. Of course, that has now been wiped out. But we did take some profits off the table early in Jan when the markets went up excessively and hit year highs. So we did take some profits off the table then. But since then, we haven't actually sold anything on this MSCI news. We will in fact be looking to add in the near future.
No, okay. Well, that was my next question. If you haven't bought already, wondering if you could be more specific, if you could, of course, in terms of what you're eyeing specifically.
I think in the meantime, of course, we want to avoid names that will be susceptible to more passive outflows. So while the banks, for example, look really good from a dividend yield perspective, as well as from a price point perspective, they are more susceptible to more outflows if things don't materialize. So things like Bank BCA, BNI, BRI, those are all massive casualties in terms of passive outflows. So we would be looking more at those stocks that have more fundamental earnings visibility, as well as less foreign exposure. So in that case, we won't have that impact should MSCI rule unfavorably in May.
Yeah, because at that point, if we do get that unfavourable ruling, you're setting up for a reduction in weighting for all Indonesian companies in the MSCI Emerging Markets Index. You're even looking at a potential downgrade to frontier market status. Does that change your thesis around investing in Indonesia at all?
Honestly, this is, again, Indonesia is on probation until May. My base case is they will find a solution. There is no realistic risk of Indonesia being downgraded to frontier market status. We have to remember it's a G20 economy. It's the largest equity market in ASEAN and one of the top 20 markets globally in terms of market cap. In terms of trading volume, last year we edged up Singapore, Malaysia, Vietnam. This is about index methodology fine-tuning. It's not a judgment on the country. So I would definitely be stepping in and I will not be reducing my exposure to Indonesia.
Mohit, I like how you put it, because the bull case here is weeks or months from today. It's rare we get price dislocations that are not fundamentally driven, right? To your point, and people might look back at this day as, that was a window where I could have gotten in, given this market has been on an uptrend and people were waiting to buy a dip, and this could be that dip. Now, I wonder if this is just, if it turns out to be just tweaking along concepts and definitions, and clearly there's something beyond that too, though. How easy of a fix do you think this will be?
I think this morning I saw our finance minister come on TV and also suggesting that the IDX, the BEI are actively looking to find a solution, and they want to find a solution definitely before May. They're looking as early as March. So in the short term, sentiment is clearly neutral to negative. Global investors are telling us, let's wait until there's clarity in May. Don't add risk yet and don't fight the uncertainty. That keeps pressure on the prices near term. But historically, when Indonesia has faced this overhang, long-term investors who stepped in during uncertainty were often rewarded once the clarity returned. So would you wait until that point in time when things are resolved? Because chances are the markets would have already priced it in and started rallying. So again, I would be looking at this opportunity to find those companies that you wanted to invest in but didn't, and missed out on the recent rally to the highs, and start focusing on your shopping list.
Mohit, in your opinion, are some of these conglomerates too tightly held? I think that's a simple question, which could have a complicated answer.
I think the Indonesia market in general, it's a market where the stocks are held by the promoters from a majority perspective. They don't let go during the IPOs. They still retain 70-80% of their shareholdings. So I think it's a common practice in Indonesia. But on the flip side, isn't it a good thing that the promoters still hold a majority of the company, in which the alignment of interest obviously would be the same for the minority shareholders? They would want to do better because they still control the majority. They would want to see the company grow further. So I mean, there's two sides to the coin, right? So if you want to look at it from a perspective that it could be controlled or price controlled, then yes, there is obviously some bad apples that could do that. But the focus should be again on fundamentally strong companies with clean balance sheets, high real free float, solid cash generation, and earnings at the end of the day. So not particularly focused again on the index flows.
We're also just, of course, keeping an eye on what's happening in the currency space, and you've got further declines for the rupiah here, actually the most since October now, amid that stock's rout, but it's also reflecting concerns around central bank independence. And I'm curious for your views on this, given we've had President Prabowo, who's appointed his nephew to the position of deputy governor. Does that concern you at all? And just talking about, business is being tightly held, but also central banks and concerns around nepotism, for instance.
We would definitely keep an eye on that. I think at the end of the day, Indonesia has, it's not the only country that has faced this kind of issue, right? I mean, if you look into the US as well, I mean, President Trump's children are very well connected in the business circles. I think we need to focus again on the underlying credentials of the person, not necessarily whether they are a nephew or a son or a daughter of one of the politicians. I would like to see, again, let's focus on the credentials. Let's see how he steps in and what he does. We obviously want to make sure that the central bank continues to remain independent of politics. So let's see how that plays out.
Okay. Mohit, I'm wondering from a market piping or mechanics perspective, how do we know, setting news aside, because to your point, right, once we get a resolution here, we're probably too late and the market's already closed that gap. Are there signs that you're watching out for in terms of being able to tell if the sell-off is close to, if we're close to the bottom on this one specifically, near term?
Like I mentioned, I think from an index level, if we looked at from the April tariff low to the recent January high, the 7,900 pullback was about 0.38 retracement, and that has now broken. So 7,500 is about the 0.5 retracement, and also aligns with the monthly and quarterly averages, specifically the 10 quarter. So I would like those levels to be held. Of course, if it continues to break down, then we have to assess our positions and maybe pivot them to certain stocks that may benefit more on the rally. But besides that, of course, in February and March, it's a bit more of a quiet period when they go into their Eid holidays and Ramadan. So there might be a slowdown in terms of a slowdown period in terms of investments. However, I would be also looking at consumption during this time and domestic liquidity. So if the consumption remains strong or there's a pickup and domestic liquidity also remains intact, I think those are good signs to watch, and we can probably look to step in. Again, for patient capital, this is very discomforting, of course, but it's not a dysfunctional market. So ultimately, index risk creates volatility, but the fundamentals will determine the returns.
It certainly is a test of patience. Mohit, thank you so much for helping us cut through some of the noise here. And let's talk again, and hopefully soon, and once maybe the dust settles on this one. Mohit Merpuri there, of course, senior partner at SMGC Capital. In case you missed that conversation, of course, they've yet to sell any of their positions given amidst this drop and this collapse in the market. I look at Southeast Asia, plenty more ahead. This is Bloomberg. Right, welcome back. You're watching The China Show. We're looking at oil prices trading at around, let's call it 6-month highs. Is it fresh 4-month high? I think it depends what you're looking at here. This one should be Brent, and I can tell you now that's a 6-month high. We're sorry. We'll fix that for you. Donald Trump threatened, of course, an attack on Iran, urging Tehran to negotiate a nuclear deal. Yeah, I can tell just by absolute levels. I've done this that long. But anyway, let's talk about this. Bilal Spence is here, our senior editor, to talk us through. Okay, so what is the Iran story today? What are we watching out for there?
So we saw this threat from President Trump, and he's talking about Iran having to come to the table to talk about nuclear disarmament, basically, or avoiding Iran developing nuclear weapons, which is interesting because previously his reaction was on the protests and on the crackdown by the Iranian regime on the protesters, and he sent this Armada, this fleet of U.S. warships to the regions, and now he's saying time is running out, Iran has to come to the table and negotiate about their nuclear weapons program or nuclear program if they want to avoid another strike like we saw last year, and that's what we see in the oil market. Every time we talk about potential hostilities in the Middle East, everybody starts thinking about the Strait of Hormuz, which is a gateway for about a third of global supply, and that's what we see reflected in the prices.
Yeah, critical choke point. What is the reaction then from Tehran, and how exactly are they assessing these demands as well?
Well, they have been saying forever that they do not want to develop nuclear weapons, that they need this sort of uranium enrichment for civilian purposes. And they have been saying they do want to talk, they do want diplomacy, they do want to avoid any sort of hostilities with the U.S. So they are trying. We heard about Iranian diplomats fanning out around the region to try to calm tensions a little bit. So they are trying to avoid any further escalation right now.
Balazs, thanks so much for joining us this morning. That was our senior editor there, Balazs Pens. And we are shifting back, well, still in the commodity space actually, but taking a look at what's happening with gold and silver today, because we are continuing to see these gains here. So gold has already crossed that 5,500 threshold. Silver also up around 120.
Something just to underscore the frenzy that's going on here on silver specifically, right? So there was an ETF, the volume and the terminal chart's going to come up. There's a full story on that if you need more details on this. So the volume specifically on the iShares Silver Trust ETF actually is on par with the S&P 500 ETF, right? Or one of the S&P, which, they should be nowhere near each other, yet here we are just talking about really how this story has really become front and center, which I guess takes us into how this is really showing up in this part of the world, Bill.
Yeah, showing up in this part of the world in different sorts of ways. We can actually take a look at some of the headlines we're tracking in the commodity space in Greater China. So this is quite an interesting one, but Hong Kong Customs have seized more than 7,000 ounces of suspected smuggled silver at a border checkpoint with mainland China. Authorities say the silver was hidden inside food cans in a private vehicle, and 2 men were arrested. Sharp gains in silver prices are driving a buying frenzy in China.
All right, Indonesia, day 2. We're down a further 8%. Trading halts there as the rout deepened for a second day. So we were down 7.5% at the close yesterday. We're down a further 8% today. So we've taken out a couple of key milestones there as far as moving averages and technical indicators on a daily basis. I guess just keep in mind this is a market that's also rallied quite substantially over the last couple of years. In fact, this and India were the 2 markets in the Asia Pacific that really were the darlings of investors, had outperformed before everyone then started to embrace AI and the other markets that have certainly come about. So there is profit to be taken here until the dust settles on this and we see a resolution to the issues here at hand.
Yeah, absolutely. But it does seem like panic selling is still sort of the modus operandi of investors right now. Let's also take a look at what's happening in the metal space today, because copper has actually just surged to a record in London. That's the LME contract there. But you're up over the past year 50% for this metal. And we had Citi, for instance, the equity strategist saying, Pierre this hour, saying he's still very optimistic, even though you've got the likes of Goldman Sachs, for instance, that are saying that actually demand for copper could cool a little bit over the coming months.
Yeah, he's still bullish in that. In fact, when you look at his forecast on earnings, it does reflect a pickup in materials and also tech. Those are the 2 sectors he thinks are going to lead the earnings upgrades here on the Chinese markets this year. Very briefly, and by the way, this is something I think we need to be talking about more of, and we probably will over the next few days. Remember 3 red lines? There was that report on the back of might no longer be red lines. Markets are reacting quite substantially. Of course, we're coming off extremely low basis on these names. That's it from us here on The China Show. Plenty more ahead. This is Bloomberg.